Are you ready to build wealth even when markets are tough? Let's talk about the strategies the wealthy use to stay ahead, no matter how challenging the economic landscape. In this video, I will reveal 3 powerful wealth building strategies that I have learned that don't rely on luck but proven techniques that work in any market. Strategy 1. Diversify wisely. Before I dive deeper into this strategy, let me explain what diversification is. Diversification is a strategy that involves spreading your investments across various asset classes or sectors to reduce risk. Instead of you relying on one type of investment, diversification ensures that if one asset underperforms, others in your portfolios are there to balance the loss. It's like creating a financial safety net. If one strand breaks, the rest still hold. So why is diversification that important? The saying goes, don't put all your eggs in one basket. This perfectly explains why diversification matters. If all your investments are in one type of asset, say stocks, and the market crashes, you could lose a significant portion of your wealth. Diversification protects you from overexposure to one single risk, helping to maintain stability and reduce volatility in your portfolio. Now that we've gotten that out of the way, what are some of the advantages of diversification? 1. Risk reduction. By spreading your investments across different asset classes, you minimize the impact of downturn in any one area in your portfolio. 2. Improve returns. Diversified portfolios often yield more consistent long-term returns. 3. Capital preservation. It helps protect your wealth during economic downturns or market fluctuations. 4. Flexibility. Diversification offers multiple avenues to grow wealth, adapting to changing economic conditions. Here are 4 key asset classes that are good for diversification. 1. Stocks. Why is it wise to diversify by buying stocks? 1. They have a high potential for long-term growth. 2. You get the opportunity to invest in innovative industries, for example, tech and green energy. 3. Dividend-paying stocks offer regular income, hence some immediate returns during the year. The second key asset class for diversification is bonds. And here are the advantages of diversifying in bonds. 1. They have a lower risk compared to stocks. 2. They provide a steady income through interest payments. 3. They hedge against stock market volatility. Do you remember the 2008 financial crisis? During that financial crisis, many investors relied on government bonds, which remained stable when the stock market plummeted. The third asset class is real estate. Why should one diversify their portfolio in real estate? 1. They are tangible assets that often appreciate over time. 2. Real estate generates consistent income through rent. Also, I don't know if you know this, real estate acts as a hedge against inflation. Owning a rental property in any growing city can generate steady income while increasing in value, even during economic slowdowns. The fourth asset class to diversify your portfolio is commodities, like gold and oil. There are many advantages to investing in commodities. These offer protection during times of inflation. When you have commodities in your portfolio, you actually own physical assets. They are highly liquid and they are globally traded. The general rule of thumb when it comes to diversification that I have learned is to spread investments across multiple asset classes to reduce risk and enhance stability. Remember, I am not a financial advisor, but this is how many experienced investors approach diversification. 40% in blue chip stocks for growth, 30% in bonds for stability, 20% in real estate for income and appreciation, and 10% in gold for inflation protection. If the stock market crashes, losses may be offset by gains or stability in bonds or gold. This approach ensures that their portfolio weathers economic crisis. To bring this home, diversification isn't just about spreading risk. It's about creating opportunities. While risky, high-growth investments can deliver high returns, Stable assets like real estate or bonds provide a balance. The wealthiest investors understand this balance, using diversification to not just survive tough markets, but to thrive in them. The second strategy is cash flow focus. Focusing on cash flow during tough markets ensures you maintain financial stability and flexibility. Cash flow refers to the regular income generated by investments, whether through dividends, rent, or interest. It's not just about having wealth on paper. It's about liquidity, having money coming in consistently to cover expenses, reinvest, or seize opportunities. What are some of the advantages of cash flow investments? 1. Financial buffer. Cash flow acts as a safety net during economic crisis, reducing reliance on savings. 2. Reinvestment opportunities. Steady income lets you reinvest in other assets, compounding your wealth. 3. Confidence and flexibility. Knowing money is coming in regularly allows you to make informed, less pressure decisions. Strategy 3. Value investing. What is value investing? This is the art of buying undervalued assets with strong fundamentals. And I will tell you, economic downturns often present the perfect opportunity to do so. When markets decline, fear and uncertainty drive prices down, even for companies or assets with solid long-term potential. Why value investing in crisis works? 1. Undervalued opportunities. Companies with strong balance sheet, consistent earnings, and a competitive edge may see their stock prices drop drastically during market dips. These are prime candidates for investment. 2. Rebound potential. Historically, markets recover, and quality investment purchased during crisis often deliver significant returns when the market stabilizes. During the 2008 financial crisis, Warren Buffett invested heavily in companies like Goldman Sachs and Bank of America. These investments, made at a time of widespread market fear, eventually delivered massive returns as the economy recovered. Key takeaways: economic crises aren't just challenges, they are opportunities for long-term wealth building. 2. Look beyond market noise and focus on quality assets with potential for recovery and growth. 3. Patience and a clear strategy are essential. Value investing rewards those who can wait for assets to appreciate over time. By viewing market downturns through the lenses of opportunity, you position yourself for substantial financial growth when the markets rebound. So, to sum it up, diversify smartly, focus on cash flow, and invest in value when the market gives you a discount. If you got any value in this video, please smash the like button, subscribe to the channel for more content like this, and please check out other videos on this channel. Thank you for watching, and see you in the next video.